Hello, welcome to a special video looking at one of the key barriers to development and poverty reduction. This will form part of a series updating you on some of the key issues to do with economic development. Primary export dependency or primary product dependency is one of the key potential barriers for countries wanting to grow sustainably, achieve inclusive development and extreme poverty reduction. Let's start with a couple of, three multiple choice questions. Have a go at these. Which one of the following countries on the African continent is not landlocked? Have a go at this question. And the right answer, if you know your geography, is Kenya on the east coast of Africa. Three countries there are landlocked, and being landlocked with poor neighbours and being natural resource dependent are two of the barriers or traps to development identified by Professor Paul Collier. Nearly 50% of world cobalt reserves are in which country? Have a go at question 2. And the answer here is the DRC. Often low-income countries, lower middle-income countries, are actually quite rich in natural resources, but they don't necessarily turn that into genuine, inclusive, sustainable wealth and lift per capita incomes to middle income levels and above. And the DRC, I think, is a great example of that, despite having nearly half of the world cobalt reserves. More than half of the world's lithium resources lies beneath the salt flats in which cluster of countries? Well, there's 4 obvious answers. Which one do you think is right? And here the right answer, it's not D, by the way. It happens to be B. Argentina, Bolivia and Chile have some significant share of the world's lithium resources. And we're going to come back to lithium in a few minutes. So what is primary product dependency? You can shorten that to PPD in essays. Well, basically, typically, countries at an earlier stage of their development, they tend to produce, extract and export a narrow range of products than advanced high-income countries with a much more variegated, differentiated range of industries. And many developing countries continue to have a high dependence on extracting and exporting primary commodities, and these nations are therefore vulnerable to volatile global prices and terms of trade. Another key related concept is export commodity dependent. Now, commodities are products that are stemming from farming and mining that have not yet been transformed, and a country is export commodity dependent when more than 60% of their exports are composed of primary commodities. Looking globally, only about 13% of advanced high-income countries are commodity dependent, compared with 64% or 2/3 of developing and transition economies. Indeed, 9 out of 10 sub-Saharan African countries are commodity dependent. A good example here is Zambia. This shows the pattern of their exports, and you can see here that well over 70% of their exports are linked to the copper industry. And here's another example from Africa with Ivory Coast. Again here, cocoa, both in terms of cocoa beans, butter and paste, accounting for well over 1/3 of their total exports. Now, primary product dependency has both advantages and disadvantages. Here are some of the key problems linked to primary product dependency. The first is that there's quite a strong link, indeed often a causal connection, between having a rich natural resource base and the risk of political conflict and corruption. You may well have seen, for example, the film Blood Diamond, featuring the diamond trade in the Congo. So there's oftentimes a significant risk of conflict and corruption, transnational corporations grabbing land, trying to buy land off governments, perhaps with the use of bribery. Resource extraction indeed tends to be capital intensive, doesn't necessarily create many jobs, and tends to increase the power of politicians and their vulnerability to bribery and corruption. I think a really key second point is that commodity export dependent countries are highly vulnerable to changes in world demand and world prices. So their macro economy is much more susceptible to big swings in world demand and prices for the likes of copper and cocoa and other primary commodities. And in many of these countries, The tax take as a share of GDP is pretty low, so risks there of higher unemployment when the industries go into reverse, and there aren't the welfare safety nets that are available to many people in advanced nations. Third issue is environmental, of course, sustainability. Those of you who are big fans of donut economics, Kate Raworth's superb book. Countries which are commodity export dependent often face the danger of extremely rapid extraction of resources, some deforestation, overuse of fish stocks and things, and that can make their growth unsustainable, leading to a shrinking stock of natural capital. Strongly recommend, by the way, you look at the work of Kate Raworth on donut economics, and also the brilliant work of Elinor Ostrom, the first woman to win a Nobel Prize in economics. Ostrom got her work for better understanding how communities can overcome the so-called tragedy of the commons. Now, we're going to be looking at the Dutch disease in a few minutes as part of this topic. Countries which are depend heavily for their GDP and their exports on commodities. If the world price of those go up, that can then drive a country's exchange rate up. We call that a currency appreciation, which then can lead to a loss of competitiveness for non-primary industry exports, including perhaps textiles and car making. So a country might well suffer from what's called premature deindustrialization, which is where their industrial sector starts to shrink in relative and perhaps absolute terms before they've moved from low to middle income or above middle income levels. Now, linked to this topic is something called the Previs-Singer hypothesis, and it basically suggests, this by the way was a theory that was developed in the 50s and 60s by Raoul Prebisch and Peter Singer. It suggests that over the long run, the real prices, the inflation adjusted prices of many commodities, from rubber to coffee and cocoa, they tend to decline relative to prices of manufactured goods such as cars and washing machines. So the basic thinking was that countries that were heavily dependent on primary commodities would tend to face growing problems over time. The Prebisch-Singer hypothesis suggested that there was going to be a long-term decline or fall in the real price of these global commodities, in part because they have a fairly low income elasticity of demand, perhaps lower than luxury household goods. So if prices fell, that would lead to a worsening of the terms of trade for those countries, and that would hamper and perhaps damage their growth prospects. And what Prebisch and Singer argued in their hypothesis was that countries might be better off by focusing their policies on what's called import substitution. So instead of relying heavily on primary commodities, try to substitute imports of cars, washing machines, motorbikes, etc. Try and develop your own domestic industries in manufacturing through a rapid process of industrialization to diversify the export base. The aim was to basically create an industrial sector which was more resilient to the international economy and price shocks. That import substitution could happen through things like import tariffs and quotas to protect infant industries. Well, although the Prebisch-Singer hypothesis has remained of interest to development economists, for many countries actually the pessimistic projection of the basic hypothesis has not really happened. Lots of reasons. Let me explain a couple of them for you. First of all, manufactured goods, particularly with globalization and containerization and technological improvements, labour-intensive manufactured goods, particularly things like toasters and kettles and washing machines, even smartwatches, they've now become cheaper because of globalization and economies of scale. So the Prebisch-Singer view actually could be now attached to manufacturing very cheap household products. Secondly, the world population has grown, extreme poverty has come down, per capita incomes have risen in most countries, and that has increased the demand for household appliances. And of course you need commodities to make your smartphones. It's increased demand for food, and that has driven up world food prices. So in many cases the primary products of certain countries have gone up, not down, which is a counter to the Prebisch-Singer view. A really good example of this is lithium, a rare earth used in manufacturing smartphones. Chile, Argentina, as we mentioned before, have nearly 80% of exports of lithium, lithium carbonates. This statistic shows the distribution of lithium end-use consumption globally in 2019. So something like 18% of lithium consumed was used in glass and ceramic products, but by far the biggest, of course, is the use of lithium in battery demand. It's a massive driver of lithium consumption. The world is moving towards something like 2 billion smartphones or something, and obviously a big surge in demand for batteries for home energy and for electric vehicles. Hence, the projection of total worldwide lithium demand is staggeringly high going forward, and the price of lithium carbonate, the average price in 2019 was an estimated $13,000 per ton. That was down from 2018, but you can see that there's been a significant rise in the price of lithium as world demand has increased. And as a result, lithium mines have produced more. They produced an estimated total of over 77,000 metric tons in 2019, a big increase from a decade before. So in many countries, the price of primary commodities has gone up, not down, which challenges the view of the Previs-Stinger hypothesis. However, there is also something called the Dutch disease. Now, the Dutch disease is an interesting idea in economics. It refers to the adverse impact of a sudden discovery of natural resources on a particular national economy via an appreciation of the exchange rate and the subsequent worsening of export competitiveness. Now, in economics, the Dutch disease tries to describe a potential causal relationship between an increase in a key sector. You discover gas, or you discover oil or something. You discover some new natural resources, and a decline in other sectors such as manufacturing or farming. The term Dutch disease was actually first coined, I think, in the early 1960s. The Dutch discovered a huge natural gas field, I think in 1958 or 59. Very, very strong demand for gas from other countries meant that the Dutch were exporting that gas. That drove up the value of the guilder at the time, the Dutch currency. But that in turn hit the demand for other exports, and in fact helped drive the Dutch economy into a recession. So the Dutch disease is basically saying if you find new natural resources and extract and export them, and you get a lot of investment into that sector, that can grow the sector, although it can also crowd out investment in other industries. But crucially, it can then lead to the exchange rate appreciating. Now, a strong currency then makes it harder for other sectors, car making, tourism, for example, to be price competitive in overseas markets. The worst case scenario, particularly for lower middle income countries, is that a significant surge or appreciation in their exchange rate can actually cause their emerging nascent manufacturing sectors to start to shrink, and that's called premature deindustrialization. So primary product dependency carries risks. The natural resource curse is countries that are rich in natural resources but never seem to grow any richer. Nigeria, the DRC, for example. The Dutch disease is where you're strong in natural resources, but that drives your currency up and hits other sectors. So what strategies might help countries avoid the natural resource curse? I'm drawing heavily here, by the way, on the work of Paul Collier in his famous book, The Plundered Planet. So here are 4 strategies for helping to overcome primary product dependence. The first is better government. So people need transparency and accountability about who is generating the natural resource tax revenues and how are they being spent. Are you managing to turn, for example, the sale of land or the rent from natural resources, are you turning it into increased spending on healthcare or education? Some countries adopt a second strategy. They tap into the external values of their natural resources, and the revenues, the dollars from those exports are saved in a sovereign wealth or a stabilization fund. So Ghana has one, Norway has the world's biggest one, and these sovereign wealth funds are basically designed to fund human capital and key infrastructure to grow the economy, or to inject money into the economy when aggregate demand dips in a recession. Absolutely crucial point is that you need to tax natural resource profits. So it's really important for a government that is whose country is exploiting natural resources to be able to tax them appropriately. So in other words, tax the resource rents from transnational corporations and then reinvest back into an economy, back into skills, back into healthcare, back into improved nutrition. All of these things can improve the human capital of a country. And, you've got to turn natural capital, resource rents, into human capital to lift per capita incomes. And finally, you've got to diversify your economies. So instead of becoming or remaining too dependent on primary exports, look to diversify. So instead of just growing coffee and cocoa and tomatoes, look to process them, look to brand them. Try and build light manufacturing industries, maybe grow your tourism sectors. Find sectors which offer potentially higher value added products, but crucially a diversified industrial base which makes your economy less susceptible to global external shocks. I love following social media for topical examples. I think Bloomberg Africa is definitely one to follow, at BBG Africa. Superb daily stories on the African continent, lots of economics. Here's a really good example. January the 30th, 2021, Tanzania. Their export earnings from gold up by a third in 2020, helped by increased output and higher prices. So Tanzania benefiting from a surge in the world gold price. And here's another example from the day before. Rwanda, one of my favourite countries to study. What will soon be Rwanda's top export. They've just signed a deal with China to sell $100 million worth of chili peppers. It could become the country's top export and reinforce the importance of farming. Chili peppers, maybe that's the hot topic for 2021. Okay, there we go. This has been quite a lengthy video, but if you've stayed to the end, thank you. I hope this has made sense and given you a really good feel for the economics of primary product dependence.